Well, there was a surprisingly dovish Fed pivot from Chair Powell and company last week, which sent equities soaring once more, with the S&P 500 notching a seventh straight weekly gain, and both the Nasdaq and the Dow ending last week at fresh record highs, as Treasury yields slipped across the curve amid a dovish repricing, sending the dollar index to its lowest level since mid-August. It was interesting, though, that Powell was something of a lone dove last week, with the ECB, the Bank of England, and pretty much everyone else sticking largely to their prior message. It is a quieter week for markets this week as Christmas looms, the calendar thins out, and volumes probably follow suit. But nonetheless, there is plenty for myself and Ryan Littlestone to discuss on this, the final Trade-off UK of 2023. So without further ado, let's get into the show. So, as expected, a busy week in the financial markets last week. Joining me, as always, to run through exactly what went on is an incredibly festive-looking Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you, mate. I think you really have pushed the boat out in terms of the Christmas wear this week.
Yeah, well, I did warn you, mate, and I was hoping you were going to turn up in something festive, which you have. So,
I was going to say I have, and unfortunately, Kyriakos' skills don't extend to being able to fit all of me in. It's been a bit of an overindulgent Christmas so far. So I will stand up to show you the full attire that we've got going on here. It's not just you in festive attire this week, mate. I will have the viewers know.
No, well done, mate. You've made the effort. It's always good to see.
Exactly that, and sadly all the shops in the City of London were sold out of bar humbug hats this week, so that's the best you're going to get from me, mate.
Well, if that's as good as it comes, I'll just have to take it, won't I? You just have to do better next year, mate.
Well, I will endeavour to raise my standards to meet what is an incredibly high bar that you've set, but it's a shame that you've got such a dodgy badge on your hat. That's all I will say.
Nothing wrong with that whatsoever.
There we go. Right. Well, now that we're all in fancy dress, let's get on with the show, shall we? Right, so there's really only one place to start in terms of the show this week, and that is with all of the central bank decisions that we had last week. It was a busy week, as we expected and as we previewed on the show last week. And I guess what was interesting for me, Ryan, is the fact that we had what was undoubtedly a more dovish Fed meeting than markets have been expecting. That tweak to the policy statement saying the extent of any additional policy firming. Powell at the press conference openly talking about how the committee have been discussing how and when they would come round to cutting rates. And of course, that dot plot as well, which now indicates 75 basis points worth of cuts to the Fed funds rate in 2024. But I guess what the most interesting thing for me was the fact that, that decision on Wednesday evening from the Fed really just opened the door to, if anyone else wanted to be dovish in the G10 universe, then they had pretty much as much license to do so as they're ever going to get. And no one took it. The ECB doubled down on their higher for longer guidance, and Lagarde at the press conference relatively hawkish, saying we should absolutely not be lowering our guard in terms of inflationary pressures. The BOE sticking to the script that they laid out last time, 5.25% unchanged on the bank rate, another 6-3 vote, a repeat of the idea that policy is going to be sufficiently restrictive for sufficiently long, and inflation risks still skewed to the upside in terms of the old lady's perception of things. The Swiss National Bank also pretty much sticking to what they said previously, although perhaps at the margin a little bit more dovish. And then you had the Norges Bank coming out and surprising us all with a 25 basis point rate hike. So I guess the question I've got for you, mate, is why are the Fed and why is J-Pow the lone dove at this point in time?
Yeah, very strange question. It was a real surprise to hear Powell being so dovish. I was expecting him to really put a bit of a fight back on against the market pricing for cuts. In the end, it was Lagarde who sounded more as I hoped Powell would be. So, yeah, wasn't expecting that one. Why the pushback or why it's such a dovish tone? We spoke about it last week or the week before, just whether, just doing a little bit of easing talk, let's call it that, might loosen up financial conditions through the end of the year. and that would aid the soft landing. It would take a bit of the sting out of all these rate hikes, allow, as I say, financial conditions just to ease a little bit, add a little bit of support, shall we say, to the economy, bring mortgage rates down, bring other lending rates down, just a tiny bit. And they can do that while inflation is going the right way and keep the message in as well. So that's been one of the reasons, I think, why he went that way. Also, just the end of the year again, just to give the market a little nod, why we've hiked and why we will need to bring rates down eventually. It's not because the economy is collapsing. It's not because anything's going really wrong with the economy. It's because we need to get rates down to a neutral level, a normal level, where we can then tinker with it, as the economy requires. So again, I think there's a bit of disparity between what the market thinks a rate cut cycle is about and what the Fed actually think a rate cut cycle is about. And that's where I think the big difference has sprung up, and where we've seen the big difference in pricing.
Yes, I would tend to agree with that. I think it's important to recognise that by cutting rates as inflation comes lower, and we've made this point numerous times before, mate, as inflation comes down, if you keep the nominal Fed funds rate the same, policy becomes incrementally more restrictive because the real Fed funds rate will rise. So by inflation coming down and you just kind of cutting in line with that, the relative policy stance remains the same. And of course, markets are pricing in a much more aggressive easing cycle than that. But we're going to get onto this in a while, I know, but I really still can't see a world where the Fed cut before the ECB. I know markets are getting very, very excited about that at the moment. And I know if you take what they said last week at face value, that's the conclusion you would logically draw. But I can't see that one personally.
No, and especially when you look at the data, what's going on in Europe versus what's going on in the US, it's chalk and cheese. So you're 100% right about that. But central banks don't need to worry about that per se. It's all about the message and how they're going to engineer their soft landings. And as you say, that's what the Fed's doing. It's letting some air out the hot air balloon, and doesn't mean it's going to crash to the ground. So, yeah, we'll keep monitoring that into the new year.
Absolutely. I fear I may have slightly stolen your thunder here on your next topic, mate.
Yes, well, it wouldn't be the first time, and it won't be the last time. But so rate cuts is obviously the hot subject at the moment, and there's been a big pushback since the FOMC and the ECB. We've had the floodgates open now, and all the talking heads, all the central bank speakers, and it's been pretty lively since Friday. Feds Williams kicked things off Friday afternoon with some hawkish comments saying they're not really talking about cuts right now. So after everything Powell said, he comes out and says, well, yeah, we're not talking about cuts. Fed's Bostic was one of the loudest calling for an end to hikes and that we were at the peak in hikes. But even he's pushing back against early cuts. He only sees 2 cuts next year, which is one less than the Fed median. So this is one of the doves who still doesn't see as many cuts as what many on the FOMC do. Then over at the ECB, we've got one of the Germans, Archhawk Nagel. He's pretty much thrown in the towel, saying it's highly likely that rates have now reached a plateau. That followed similar comments from our mate Hawky Holtzman. Another hawk, Pierre Wunsch, today said investors are too optimistic about March cuts, early cuts. And all this comes on the back of stories about the ECB saying that governors don't expect a change in the message on steady rates before March, and a cut before June is difficult. So how we going into 2024, there's still a big divergence between when and how many cuts the market sees and how many the actual central bank sees. And that's going to dominate the day-to-day price action around those data points going into 2024. But there's definitely been a strong pushback, especially against any sort of March date for cuts, be it the ECB or the Fed. And I think that message is going to continue.
Yes, I completely agree. And of course, I think it's important to remember that, when we get these sources stories in Bloomberg or Reuters or whatever, they are deliberate, they are planted there, and they are planted there for a reason. And that is because central banks want to get a message out. I must admit, the messaging from the ECB is getting a bit farcical at this point. You mentioned Nagel, I think it was, saying rates are on a plateau. The French central bank governor, Villeroy, went one step further last week, saying rates are on a plateau, and we can now admire the view. To which I would say, what view? The entire Eurozone economy imploding? Because that's kind of what the PMIs last week pointed to. I think the guidance is still higher for longer. Loretta Mester from the Cleveland Fed was in the FT earlier. She votes next year, of course, again, banging that higher for longer drum. But I think the market has got its first whiff of a rate cut now from Powell last week, and it's going to be very, very hard to stop money markets and bonds and, of course, equities really running away with that theme. And then you've almost got to question, what damage do you cause by really aggressively pushing back on that? And do we get into a scenario where central banks are perhaps bullied into cutting rates again? We've obviously seen it before numerous times, and we could even see it again, not necessarily as soon as March, but perhaps at some point during the next 12 months.
Yeah, exactly that. And my colleague Blake spoke about it today as well, saying, what is the Fed going to listen to the market, or is the market going to listen to the Fed? And we know always that the market likes to get overly extreme with its calls and what it thinks going to happen. So I think it's likely that the market is going to go too far. It's already too far. We're still pricing for the Fed, for example, some, 120 basis points of cuts next year. And that's still after the Fed say, well, no, we're only getting 75. So that's where that divergence is going to come into play.
Yes, very much so. And I think that's going to be one of the many things we need to watch in 2024. And we'll get onto that momentarily. But before we do so, I just want to take a quick look back at the last 12 months. This is obviously the last full trading week of 2023, with Christmas coming up next week. And the last central bank decisions of the year are pretty much out the way. We've obviously got the BOJ this week, but by the time this goes out, that will have been and gone, and central banks will be properly done and dusted for the year. And the data docket this week is also pretty light. So a decent chance to take a look back at what's been a bit of a roller coaster ride over the last 12 months or so, just to pick out some of the key themes. When I sat down yesterday and tried to look back at everything that had gone on over the last 12 months. We obviously had continued policy tightening across developed markets in the first half of the year, and then that has slowly but surely gone and turned into a pause, and then an outright dovish pivot, as we were just discussing, from the Fed and perhaps even from their colleagues going early into 2024. Disinflation has continued, but as that has continued, growth in the US has blown out all expectations and going absolutely gangbusters. And even though things are looking pretty grim on this side of the Atlantic, both the Eurozone and the UK thus far have managed to avoid a recession. Of course, we had that regional banking breakdown in the US back in March. That feels a hell of a long time ago. And then after that, we had UBS being forced into a marriage that they never wanted to make with Credit Suisse. China has disappointed all year, just stagnating and never really managed to recover, and now dealing with outright deflation as government stimulus fails to meet both market expectations and arguably what is required to actually give the economy a much needed kiss of life. We've had geopolitical flashpoints left, right and centre, and sadly that continues into the end of the year, with now issues in the Red Sea and shipping companies rerouting large container ships and oil tankers all the way around the Cape of Good Hope rather than going through the Suez Canal. We obviously had that bubble and frenzy with AI and the Magnificent Seven, those tech stocks outperforming and underpinning markets for pretty much the entire year. But despite that, volatility has remained relatively low, especially in the FX market. And of course, above all, we've had another year of impressive equity returns on Wall Street, as we mentioned, or as I mentioned in the introduction to the show. Both the Nasdaq and the Dow now back at record highs, and the S&P is not far away at all. But amid all of that, perhaps the most interesting thing that stands out is that we ended 2022 with the 10-year Treasury yield trading at 3.89%. As I sit here now at 25 past 2 on the 18th of December 2023, the 10-year Treasury yield sits at 3.94%. So it's been a hell of a roller coaster ride. But amid all of that, the 10-year is ending the year 5 basis points higher than where it started, which I find quite remarkable. But Ryan, my question for you, mate, what's the biggest, most important, most significant takeaway from the last 12 months?
I think it was a pretty quiet year, wasn't it? No, I think the most important thing, purely from a trading point of view, is that we're still able to be surprised, in this industry. The market's still able to surprise us. I mean, it's another year where bank forecasts, all out the window. And as much as we take the mickey out of them, there's a good thing about that, because if everyone was 100% right on what markets were going to do, what the Fed were going to do, what policy was going to do, what economies were going to do, we'd have pretty boring trading markets, because everyone would be priced correctly and there'd be no interchange between that. So there'd be no surprises. But the fact the market can still get surprised, no one was expecting rates to go as high as they did. I remember beginning of this year, some were calling for a peak rate of the Fed at 3.75% or 3.5%. When we ended up in the fives. So that's good. We can still be surprised. We can still have events come out of left field, like the banking issue in the US. And for us, that gives us the trading volatility, gives us the surprises, gives us the moves that we can hopefully trade. So, yeah, it's more the case that markets continue to give us volatility, and that's probably the biggest take from this, and hopefully that will continue. I think it is going to continue into 2024.
I think it definitely will. Well, go on then. We're going to talk about 2024, but what I'm not going to do is use the phrase I used in one of the other shows we were doing, which caused everyone to break into absolute hysterics. So all I'm going to say, Ryan, is take it away.
Well, what was that phrase, mate? Let us know again.
If you're interested, go and check out the outtake video on my Twitter account. I'm not even going there again.
I'll try to fish it out of him, folks, but he's not for turning. But yeah, we're going to look at the 2024 crystal ball, and I've picked out 4 things that we need to watch next year, the big events and the big changes that might be coming. First off, good old Bank of Japan. Can they finally end their easing cycle? Can PM Kishida, get the spring wages jump he's after, which will allow the BOJ to finally end negative rates and hike for the first time in nearly 18 years? Will inflation hold up for them, or have they missed their window and will catch some of the same disinflation everyone else has? Will 2024 finally be the year of the yen? And I'm going to hashtag that one once I finish the show. I think it will be. I think they've put a lot of eggs in one basket over wages, and they're pushing hard to achieve them. They are succeeding to change the mindset in Japan, and that's probably the biggest change that's going to happen in Japan for many years. So I can see the Bank of Japan finally coming out their easing cycle. Secondly, is 2023 going to be as good as it gets for the US? We've seen solid growth through the year, a stubbornly strong jobs market, an even more stubborn consumer, and a Fed now ready to tee up cuts. What will a soft landing actually look like? In my opinion, it's going to be growth that's at least 2 to 3% or worst case for the year. The jobs market's still doing well, but maybe has the odd wobble. Inflation coming down, but not overshooting 2%. And all that will allow the Fed to get rates down to maybe 2.5, 3%, and then hold them there and only tinker when needed. So if a soft landing is achieved in those sort of circumstances, I think the dollar could be the outperforming currency and come out on top for the year. Thirdly, will the ECB overshoot on inflation the other way? This thought really has been triggered by that last CPI print, 2.4%. Yes, the ECB expect inflation to rise a bit over the next few months, but the more over the next few months, but some soggy economies that we're seeing at the moment, the more prices dissipate, the more firms are likely to start cutting prices just to stoke demand. So that's going to add a secondary disinflation pressure to economies in the Eurozone. So entering a mini deflationary phase could be a very big risk that not many people are thinking about right now. And lastly, fourth on the list, and I know Michael's going to love this one, when do we start trading properly the US and UK elections? The US elections are set for the 5th of November. And, there's no date set yet for the UK elections. Now, For the US, the market will start taking notice when we start to get a big uptick in opinion polls. I'd say that's probably going to start getting into that sort of area from Q2 and really start ramping up in Q3. And that's when the market will probably start trading some of the outcomes from those polls. So with the possibility of Biden, squaring off against Trump again, I really have no idea how the market's going to trade that one. An early guess that perhaps a Trump return would be the more negative outcome for the US. That's not a political call in any way, but just a call on the drama that he caused when he went out last time. So the market, I don't think, will want any more of that. So that's my big thoughts for next year. And I'm going to ask you, Michael, what are you watching in 2024?
Oh, well, I'll be trying to stay as far away from politics as I possibly can. I'm already sick and tired of that. And we've still got another 11 months to go until the US election. My only political wish is that we don't have a UK election anywhere near having the presidential election in the US, because otherwise that will be pretty much hell on earth, I think is the best way to describe it. I think, I could talk about next year for hours, but I don't particularly want to bore everyone. Everyone wants to go home for Christmas at this point. I guess the biggest thing, or maybe question, that I'm looking to answer as we move through the next year is this, and that is, why do central banks cut rates? Because I think there's probably two realistic reasons why central banks would look to cut next year. And I think each of them produce a very different market outlook. So do central banks, be it the Fed, be it the ECB, the BOE, whoever, I'm talking DM here, of course, do they cut rates to just stick the soft landing? As you said, inflation's back at target, growth is doing okay, the labour market is softening, but nothing particularly dramatic, and they're cutting rates just to make sure that the economy achieves that soft landing that they desire. If that's the case, then a rate cut is going to be good news for equities. It'll probably be bad news for the dollar, and Treasury should rally across the curve. Or do we end up in a situation where central banks are cutting rates because growth has fallen off a cliff, because the risk of deflation has risen massively, because labour markets have softened at a much more significant and substantial rate than we expected, i.e. it's a hard or a crash landing? And if that's the case, then I think a rate cut is actually bad news for equities, and it's probably good news for the dollar, because you're going to have that haven demand coming in. So I think that's the key thing I'm thinking of next year is, yes, we're going to get rate cuts. I think that's pretty much guaranteed. When we get rate cuts, how much a rates cut, does that really matter? I think the reason why rates are cut is the much more important factor that arguably markets are pricing in at the minute. You look at the OIS curve in the States, 140, 150 bips of cuts priced out to January 2025. What economic scenario gets us 150 basis points of cuts over the next 12 months? I would argue that is not a soft landing that gets us that degree of loosening. So the rationale behind central bank actions is probably my big focus going into next year. Although, usual caveats apply, year-end outlooks tend to only last about 3 weeks anyway, and Goldman put theirs out at the end of November, and they've already revised their S&P 500 price target twice. So, I'm going to hope that lasts a little bit longer than 3 weeks.
Yeah, I remember that last year. All the banks put out their forecasts, I think, towards this time last year. And I think some of them lasted about 5 days, didn't they, into the new year last year? So, yeah, forget those bank forecasts, but they're good potentially for counter trading.
Absolutely. Right. Well, let's see if we can make some forecasts of our own and have a look at some charts. Resolution for next year: make that title segment shorter. It seems to get longer every single week. Right, I want to have a look at the S&P 500 first of all. It is the last show of the year, so it'd be rude not to bring up a chart that we've been looking at all year. And of course, the Santa rally continued to gather pace last week. A dovish press conference from Chair Powell, and a dovish dot plot, and a dovish statement from the FOMC, adding further fuel to the fire for risk assets. As we said, the Nasdaq and the Dow both back at record highs, and the S&P doesn't look like it's going to be particularly far behind them, with a close now north of that 4,700 mark, and us gunning for the prior all-time high that we set all the way back in January. Now, we did have a 7th week of gains last week, which is a very, very bullish sign, of course, for momentum, and of course, trading close to those all-time highs is a promising sign in and of itself. But what I would stress is, and I think this is important, is that we need to think about what time of year it is and the number of market participants who are going to be at their desks at this time of year. And the reason why I say that is because, as you can see from the chart there, we've come from, just above 4,100 all the way to 4,750-ish in the space of about 2.5 months. And if you've been long for a pretty long period of time, it may be prudent, and I would certainly be thinking this, to actually start to close those positions out, lock in those profits, take them off the table, put your feet up for Christmas, come back and reassess things in the new year. And I think a lot of market participants are probably going to be thinking along those lines. So in what is going to be very, very thin holiday trade over the next couple of weeks, I would actually argue that near term, the risks may point to a little bit of profit taking and a little bit of a move lower. But as we move into next year, I am still bullish, and I do think it's only a matter of time before we do get the S&P 500 catching up with an all-time high of its own.
Yeah, very much agree, mate. I was saying it this year, our stock's going to return to reality and trading economics rather than, whether we're easing or hiking. And, yes, the US economy is doing well, but we've even seen the German indices. Germany's in the right mess, and the DAX is still making all-time highs. So there's still an element of fairy tales-ness about what's going on in stocks at the moment. I don't know what happens coming into the new year. Maybe a bit of reality bites. We're obviously seeing a lot of rotation this time of year, and we've seen a lot of rotation out those Magnificent Seven, those Mag 7 stocks as well for a bit, but they're coming back as well. But I think you've got to go with the flow for the rest of the year. Come into the new year, just see what the market does, because we probably get a lot of people going, okay, Santa rally, 3rd of January, 2nd of January, let's start selling stocks. And then they see their faces ripped off as it just carries on shooting higher. And then once they get stopped out, then it reverses. So always be careful this time of year, as you say, Michael, and let's let the first week of the new year define what's going to happen thereafter.
Absolutely. Very sage advice, as always. Right, why don't we look at... I can't speak. Let's just move on. It's been a long year, mate. It's been a long year.
Okay, you put your feet up, have a cup of tea, and I'll get through it. We're gonna talk about US Treasury. I'm going to talk about US Treasuries. Michael's going to dribble in the corner somewhere. We're back on. We're back on Yield Watch because obviously there's been some. He's crying out. There's obviously some big moves in the Treasury space as the market digests what the Fed stance is on rates. It's gone. Oh, look, we can even see the pivot.
Carry on. Just carry on.
I don't know. You're going to kick me off now. Now, you mentioned this earlier, that the 10-year yield is sitting around about the opening levels of last year, which is right. We're sitting around support around 489, 490. It's been a bit of a level that's shown up since the FOMC and everything that's gone on. So we haven't managed to break under it, as Mark mentioned earlier. We have had a little bit of bounce into the 390s. Whether this is going to be a short-term bottom or something more remains to be seen. But if it has gone by the time you see this, keep a close watch on the next level below, down at 370. That's an area as the next place where perhaps yields might pull up. It's 10-year yields that are the best gauge for what the dollar does, but it remains wise to keep an eye on the short-end yields too. 1-year yields is worth just keeping an eye on, just in terms of what it means for these Fed rate cuts. It's currently trading at 5.02%, which, give or take, is some 50 pips above where the Fed sees rates dropping to next year. The 2-year yields, which is more widely watched by the markets as a broader gauge for short-term rates, yields are, or were when I did this, at 4.18%, which is 42 pips below where the Fed median is for 2024, but it's 60 pips above the 2025 median. So all this means that the bond market doesn't look as dovish as some other parts of the market. So what I'll be looking for from this is to potentially counter trade if those other parts get far too extreme compared to what assets like yields signify. So that's what I'm looking for 10-year yields, and hopefully if Michael's recovered now, he can reply to that.
I was going to say I was too busy dribbling in the corner to work out what you were saying, I'm afraid, man. No, I think you're absolutely right on Treasuries in all seriousness. If you wanted a trade for next year, I mean, this is a massively consensus view, but I'm going with it. I'd actually just be buying twos at this point. 4.5% yield when we're going into an environment where the Fed are going to cut. You can't really argue with that at this point, to be quite honest with you. And also, just to second your point that you made about the 10-year yield, it is the most important interest rate in the world. I don't think that's understating it in any way. And I've said it before, I'll say it again. If you're not looking at it, then you're doing this wrong, I would argue.
Yeah, very much so. Always have the 10-year yields on your chart somewhere. You can easily look at it just to see what's going on and match it off with what the dollar's doing.
Absolutely. Right. I want to have a look at the euro, as it says on the screen there. What Lagarde giveth, the PMIs then taketh away. We had a couple of big figure rally last week. You had the dovish FOMC, and then you had a kind of hawkish ECB meeting on the back of that. So the euro rallied all the way from 108 back into that 110 big figure. And so it has proven once again, a move north of 110 was too tough of an ask for the common currency, exactly as we saw back in November, where we get there and then we back away very, very quickly. But of course, we also had a fundamental catalyst for that move this time around with those dismal PMI figures on Friday, not only from Germany, not only from France, but the Eurozone as a whole, just very, very grim. And the contraction in the bloc actually starting to deepen as we moved into the winter months. That data, of course, being the flash figures for December. So with 110 having been rejected once more, and as I said earlier, I really can't see an environment where the ECB actually hold higher for longer than the Fed do. I think that we're going to get a move back down towards that 200-day moving average, which is at 108.30 and almost back where we were before the FOMC meeting. If we do get some more hawkish Fed speak in line with what we've heard from Williams, Bostic, Mester, etc., then that could be the cause for it. But I think the other thing that's important to remember, not just here, but across the FX market this week is, of course, those caveats around liquidity and volumes, but also the fact that we've got, month, quarter, year-end flows, God knows what else is in the mix as well. I would expect and hope that most of that is out of the way, but do just bear in mind that around those fixing times, particularly the London fixing 4 o'clock GMT, we could get some funkiness, shall we say, as those flows begin to work their way through the market.
Yeah, this one was a bit of a coin toss last week. It could have gone either way if we'd had a really hawkish Powell and a less hawkish or a bit dovish Lagarde. This one could have been sitting around, 107s or below, but it's completely flipped around. Technically, it pretty much bounced from the 50 fib of the move from that down 104.50. So technically it held that level. We had a few people thinking, okay, when we came off that last 110 move, this was the end for the euro. It's going all the way back down to 105. But the tech levels held and we bounced from there. Can we get back to the 110? That's a possibility. I wouldn't rule anything out this time of year. If we do get up there pretty quickly after that last test, though, I'll be worried about a break. Well, I say I'll be worried. I'm still long euro dollar, so I wouldn't be that worried. But objectively speaking, it would indicate that we may begin a break higher up, and then perhaps we start to stretch our legs and form a newer range going into the year, perhaps a higher range, maybe up to 112, 114, 115, something like that. But for now, it's holding, it's doing what it needs to. It's maintaining this move off of that 104.50 level that we had earlier. So it's keeping the trend in play and would suggest that maybe we're getting more upside.
Good stuff. Ryan Littlestone there talking his own book. And why not? Because he's not going to talk anyone else's. Right.
Yeah,
Why don't we have a look?
Talk mine.
Sorry?
No one's going to talk my book. I'll just talk, so I might as well talk it myself.
Exactly that, mate. Why don't we have a look at the loonie?
Okay, well, I'm not in any trades in this one just yet, so I'm not talking about anyone's book for this one. Dollar CAD, another chance perhaps to play the range. For all the moves we had in the loon this year, it's roughly held a range 132, 138 with the odd extension. With the pair now holding below 134, there's a good chance we end up testing the lower end of this range around 132. So I'm eyeing that level up for a long. I would be prepared to give it a bit of room, maybe down to that 131, 130.80 you can see on the chart there, just around, just below that fib level that we previously tested. That 131, 130.80, a good area to play stops under. If we do break that, then potentially we're heading a lot lower. This one might require some patience, as I won't be looking for a quick smash and grab on this one. More of a longer term trade, just to see if we continue to play that range, which can take several weeks to play out. So with the Bank of Canada chief Macklem muttering about cuts like the Fed chief, that may keep some strength in the CAD. He's going the opposite way. They're still keeping rate hikes on the table and pushing back against cuts. So it may keep a bit of strength in the CAD to see it down to that level, but there's a good chance that the Bank of Canada won't be too far behind the Fed in the rate cut game next year, which then might lead to some upside for dollar CAD.
I'm worried I'm going to annoy some Canadians here, but I'm going to say it anyway.
Oh, don't. You managed to tee off some Antipodeans the other week, and now you're going to do it to the Canadians. Go on. Let me just add a disclaimer. I have nothing to do with Michael Brown's comments. They come from his own lips, and I had no backing of them whatsoever. Go on, carry on.
Genuinely, Bank of Canada, what's the point? They're just going to do what the Fed do with about a 3-month lag. Go and pull up a chart. BOC overnight rate, Fed funds rate. It's pretty much exactly the same, maybe a very, very small spread between them, but they always move in the same direction. So if something's going to move this, I think it's going to be crude, it's going to be risk appetite, whatever. I can't see it being policy divergence.
Okay, I said just as much, but I said it in a much more polite way. And now you've pissed off another nation. Okay,
it's all right. They're only the second largest country in the world by landmass, but it could be worse. Right. For the record, I've spent a lot of time in Canada. It's a lovely place. I do very much like it, and I hope I'm still welcome back. Right, let's get on to our plays of the day.
Right. You want a promise for this one?
Excuse me.
You want a promise? Come on, you know it. You know what you're going to do.
No, I do not. Right, it is Christmas. Everyone is done for the year. So my last play of the day of 2023 is courtesy of PNC Financial Services, because they have put together what is brilliant. It's a total Christmas price index, which allows me, and I'm not going to sing it, but to go long. 12 drummers drumming, 11 pipers piping, 10 lords are leaping, 9 ladies dancing, 8 maids are milking, 7 swans are swimming, 6 geese are laying, 5 gold rings, 4
gold rings. If you're not going to sing, I am.
4 calling birds, 3 French hens, 2 turtle doves, and of course, a partridge in a pear tree. So unfortunately, you can't trade it with Pepperstone, but that is my final play of the day for 2023. On a more serious note, though, firstly, it helps to show the impact of inflation on the price of your Christmas dinner over the last few years. But also now is really not the time for some sort of longer run, thematic, or any kind of macro trade ideas, or really any type of sort of short-term smash and grab trades either. It has been a very long and eventful year, and as markets begin to settle down and quieten down for the Christmas period, now for me is all about capital preservation. It is all about having a rest, a break from the screens, getting yourself set to have a very, very solid and hopefully profitable start to 2024.
Well said, mate. Well said. And I'm not going to add much more to that. I'm going to quickly talk about year end and the potential screw
from a very questionable picture.
Yeah, easy for me to say. Definitely no singing for me. I have a voice for football terraces, not TV and the stage. I too don't have a specific trade for this week, same as Michael. It can be a funky time of the year, so what I usually do is watch out for any market skews that might pop up. If I see a big move in a particular asset that's not news driven and perhaps is outside of what the fundamentals are saying and the general trends, I might have a look at a counter trade. But otherwise, this week is really about reducing risk and respecting the market conditions. I've seen plenty of people ruin a good year trying to push bad trades in the last 2 weeks of a year. So as Rudolph there is finding out, Santa pushing him might look like a bit of a bad trade. That was the ethos behind that picture, Michael.
Not this Rudolph.
Not that one. Yeah, that's a kind of looking Rudolph than this one on the screen. But finally, what I wanted to say is a big thank you to all our viewers on behalf of myself, and I know Michael will echo that as well, for watching us here on the trade-off. I'd like to thank Michael for having me on the show and all the Pepperstone crowd, and Kyriakos for putting up with things like this through the year. And thank you very much. I wish you all a Merry Christmas and a Happy New Year, and look forward to seeing you next year.
No, absolutely. I will very much echo that, mate. It has been an absolute pleasure to have you join me every week over the last year. And of course, we have not missed a show over the last 12 months, unlike some people who present a version of the trade-off. As you said, on behalf of yourself and of course, Kyriakos, thank you to him for bringing this together, because if he wasn't around, let's be honest, none of this would be happening. On behalf of the three of us, we hope you've enjoyed the trade-off over the last 12 months. As always, if you have enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets. We all wish you a very Merry Christmas and a Happy New Year. And we will be back in early January to do it all again in 2024. So thank you very much for sticking with us over the last year. Enjoy the break over the festive period, and we'll be back in January. Goodbye for now.